Hey, welcome to the closing beat, everybody. A little bit of a rough one here. The hurricane really put a hurting on us down here, so we're still getting everything put back together. We did have a little bit of issues with some equipment, so in the office we had to order everything, and we're getting back to it. But I wanted to be here for you guys to make sure you know that we are doing the closing beat. I will be here, hurricane or not. We're going to figure it out. Anyways, we are financial advisors here at Jazz Wealth. We hope you'll check us out, jazzwealth.com. You can even schedule a call, see if we're a good fit. If you're working with one of the bigger advisors out there, come on, check us out. We're the little guys that pay attention because we're here. Anyways, we're going to talk about the stock market because we're one of the only advisors that can actually do that. And we're going to start by looking at the performance of the market. Now, we're also doing something else. It's called office trades. If you want to look on our research site, jazzwealth.com/research. If you don't want to be a client, but you want to learn about trading and the short-term stuff, that's not really what we do here. We do more of that there. It's $13 a month, and all the proceeds go to support Drumcore International. We are a sponsor of them, the official financial services partner. And so we use that to help them out as well and help the kids throughout the summer. Also, there was no Wine and Wealth last week because of the hurricane coming through coincidentally on the same day. So we were hunkering down and doing that, but we will get back to it this week. On the screen, you got the S&P clearly in an uptrend. We're talking longer term picture here, right? We're looking back a year in this case. Today, the focus was really more on the banks, right? So you got Bank of America reporting earnings. You had Goldman Sachs and Citi reporting earnings, and they all beat, right? So the question, the title of the video is, should these be financials in your retirement portfolio? And what I mean by this is like, should you be adding them now, right? Well, you might want to think about that just ever so slightly. The financial services sector, if we're looking at the global banking centers, not like the regional banks, we're looking at the big guys there. This is a point where you're just happy to go along for the ride. If you have a mutual fund in your 401k, you've got some financials in your IRA, Roth, whatever it may be, they were doing great. They were already doing good. And so a lot of the performance you saw today was either a gap up that reversed, people taking profits, or kind of just like nothing exciting, no real promising big shoot off type day, because that sector is already overbought. If we look over here, yeah, that looks great. By the way, JP Morgan is the least overbought. But what I'm showing here is the net percentage of stocks in the financial sector that are making new highs. In other words, a greater percentage of them are making new highs. Well, in the short to midterm, that's going to mean that sector is mostly overbought. In other words, you kind of missed it. If you didn't already have some of this in your portfolio, you don't want to start now. I can't tell you to do that, but you kind of go, well, I'm overpaying at this point. We can also see through history, just a 1 year look back, a simple one here. Whenever the financial services sector actually starts to find more stocks getting overbought or making new highs, that tends to be about the short-term top. So you might look at that and say, I like financials. In fact, State Street, let's take a look at State Street and let's see, State Street and PNC. Notice a difference here. So the regionals actually are overbought and continue to find that excitement there because they did better overall, at least what we know so far with the regionals. We haven't had a lot of them there, but see how PNC and State Street, a little different than your Goldman Sachs. Right? Look at the reversal here on Goldman Sachs after the gap up. It's not bad. I mean, I'm not saying that's the end of the world. Bank of America gaps up and retreats. Why? It's just profit taking going on in there. Citigroup being the worst, right? Retreating after gapping up. But you find that it's different. PNC, it gave back a little bit there. State Street gave back a little bit, but all in all had a positive day. So there's a little bit different there because what's known as net interest income. We did this last quarter as well to talk about what we're looking for in banks. They're very difficult to analyze, at least for me, to look at their financial statements and figure out what's going on as compared to something like, Yeti, right? So they have a few things that they sell, and they have, up till recently, have been selling a lot of them, and you can see that, right? Well, banks have a lot of different things that they do, at least the large ones. The smaller banks, they go, hey, we kind of just do lending, maybe some commercial stuff. We're not too big into the trading fixed income world that you'll see reported from Goldman Sachs and others. We don't necessarily have much in the investment banking world. We're not in the wealth management space as much as the bigger guys are. And so the big focus there is net interest income. Well, for both of them, one of them was at State Street. Net interest income was up 16% and rates came down. right? Granted, it wasn't much in that quarter before rates came down, but you get what I'm saying. So those had a little bit different of a sort of a approach to earnings so far, but we don't have many names there. So you can't necessarily go, oh, well, then regional banks, that's where I'll go. Need a little bit more information. So all of that takes the attention away from the broad markets. And actually, a lot of news events today took the attention away from the broad market as a whole and into these different areas, whether it was bonds or oil, we'll talk about in a second, or something like the banks and regional banks. If you look at the NASDAQ, well, wasn't much to report there. NVIDIA pulled back a little bit. A lot of the bigger tech names pulled back. And so we don't have any news. We have nothing to get excited about. We don't have earnings, at least right now. They're coming up. But we don't have that. And so for the moment, people decided, maybe I'll take a little risk off going into it. The small caps as well. I don't have anything bad to say about small caps at the moment. It's just I don't have any new exciting news there. If you look at bonds, I mentioned a second ago, after finding rates have climbed up over the last couple of weeks and bond prices moved lower, find a little bit of a bottom maybe. I don't know. That's what people thought today. So whether you're looking at the short term or the long term bond, treasury, you're going to find the same exact thing. Hey, if you're worried about inflation, then you like what's happening with oil. Still very much in a downtrend here, although it's trying to break. There's this concern and excitement around what we talked about this last week. The geopolitical events are short-term noise, which you can trade if you're into that short-term stuff. But for the longer-term investor, you go, did we solve the supply issue that everybody's worried about there? No, we didn't solve for that. Did we solve for inflation? It seems like that's working. But the overall long-term view of oil right now is we have a supply problem, meaning we have too much of it. And so that's holding the price of oil down in between all of this. Hey, will Israel bomb their Iran's oil areas and all their sort of focus on oil as a retaliation? Or will they focus on the military side of things? Well, Israel basically clarified, we're going to retaliate, but we're interested in making this a military effort and not trying to disrupt the entire world as far as oil goes. They're mostly their words, not mine. So anyways, you have oil basically down from 65. You get the September rally, takes you almost up to 80 there. And now we're down another, 4% here today. Remember, the oversupply issue is the concern. We'll get more information on that tomorrow. I do want to point out one other thing. This is kind of my focus for the day. I'm going to use the Chinese markets. I'll use an ETF so you can look at it as well. The FXI, you can see it on your screen. Well, what we have over the last couple of weeks, remember, there was this incredible rally and we talked about it on the show. I broke down how the Chinese government and the People's Bank of China was going to go through and actually try to not manipulate, but take some of the bad debt off of the state banks. So if you want to learn more about that, we did a whole breakdown. But we also talked about things that go too far, too fast. That is not something you want to focus on there. So now we have the reversion to the mean, right? Reversion to mean being we're just reverting back to average prices because we went too far, too fast and people got excited. They took their profits. Things got overbought. So things like Alibaba, which we actually have, still have a trade in our office trades on the research site, jazzwealth.com/research, if I could shamelessly plug that again. And again, it's not for us to make $13 off of you. You know what I mean? Like, I think this video will probably make $13 off of. So the whole goal there is that's my passion project is Drum Corps International. So if I can help you learn something about options in particular, help you make a few dollars, then maybe you find that it's worth it. But certainly check that out if you would. Anyways, by the way, we sold the 115 calls if you're curious and want to know. So we already have them, but way up here. Could have done better on it, but hey, I'm not complaining at this point. So anyways, if you're looking around at these Chinese stocks, all of them together, Pinduoduo, JD.com, you can actually look at Toyota Motors. It just doesn't matter how you're going to look at the Chinese markets. All of most of this was just reversion to the mean. You got to be very careful about that in any of the hype that you get involved in. I could list off, and I think I will list off a few things that previously have done that. How far back do you go? Do you go back to the tulip craze? No, none of us do, right? If you ever want to learn something about that type of pattern, just look up the tulip craze. It's fascinating that that's what people got really excited about for a short period of time and then bust, right? Prices fall apart. We saw that in pot stocks, right? It was a big deal. We saw that in crypto. You see that from time to time in crypto, and especially through that real heyday there where everything was going crazy. You see that in 3D printing stocks. Do you remember that? Oh, what was the other one? Alternative meats. That's the future, right? They hype it up on TV. You pay way too much for these stocks. You get yourself in trouble. Do me a favor, list a few down below. What did I miss? I know I missed a bunch of them, but those are the ones that come to mind where people looked at something like this. Prices are running away. Oh, I'm going to rip one off from you. The meme stocks, your GameStop and AMC. That was a recent one. But people see this stuff and they feel like they're going to miss out. What's the trouble? You're in big trouble, right? And the reason why you see such a reversion to the mean is because the greatest number of people chase it at the last possible second. You wouldn't think that'd be possible, but look down below there. See the volume bars in the background? Where's the greatest amount of volume picking up? All these people, 1, 2, 3, 4, 5, 6 days of this chaos in individual stocks too. Well, now we have the heaviest of buyers all chasing up here. So who's going to be the most nervous to sell when something like this happens in one day? Remember, they were closed for a week, but when that happens, all of a sudden those people go, I paid way too much. Oh no, I'm losing too much. They get out. And that creates that part of what creates that reversion to the mean there. So I wanted to focus on that for a second, just because I like to be able to go back and instead of say, I told you so, I like to be able to say, we talked about it beforehand, we talk about it during, and then we see the outcome after it. So I like to try to go back to that. All right, you ready to get fired up about some stuff? About these elections? Come on. It hasn't been that bad, right? Like the elections, the drama behind the elections, the chaos, the emotion that it makes us all feel, I don't think it's been actually that bad. I could tell because I don't really have any clients calling saying, I hate that lady or I hate that guy. Get me out of this, get me out of that. No, 4 years ago or almost 4 years ago? Yes. But just to have a little fun with the stock market and the betting odds. Did you know there's an actual pattern there? Stick with me for a second. The stock market tends to trend with the GOP's odds of winning the election. And I'm talking the presidency, not necessarily the House and the Senate. Well, check this out. We go back to the 19th of April. The S&P bottoms at the same time that the GOP odds bottom, and this is not a survey, this is the actual betting odds. And they trend together. They top out together as well as the GOP odds kind of fall apart with Kamala Harris coming into the race and everything. And because remember, it was going to be Biden and Trump, and people were like, ooh, I don't know about Biden. Well, Kamala Harris comes in and is, okay, now the GOP doesn't have as great of an opportunity as they did. All of a sudden, the market fell with it as well. Isn't that kind of interesting? And if you look, we're trending along with the same thing. Well, be careful here. If you believe in this sort of stuff, I just think it's fun to look at. But if you believe in this, currently, the GOP odds to win the president, the betting odds to win the presidency are starting to top out. What would that do for the market? What happened today? Started to top out. What happened to the presidential odds today? They actually fell a little bit. So it's just kind of a fun thing to look at. This is not my data, by the way. This is people that look at any and everything as something to add to their pile. Am I bullish? Am I bearish? Do I want to buy more? Do I want to hold? Or do I want to sell? So that's what people do, is they say, well, that's one thing. Well, we know that elections cause the markets to move in the short term. They have zero impact over the long term, unless you want to attribute the market to a presidency and the actions they took. That's fine too. But people like to go, well, that's one thing. I would never make an investment decision based on that one thing, but that goes into the column of maybe a little bearish coming up. And then you find something else. Or like the net percentage of stocks that are overbought in the financial sector. Well, financials are not the biggest. They're the third biggest sector in the S&P. So if they tend to roll over and have a bad move, it's not going to be the end of the world for the S&P, but it will create some pressure. Okay, well, we know they're overbought. And we know that historically, when the greater percentage of them get to being overbought, well, that tends to create a little short-term pullback. So it's not necessarily the most exciting thing to do, but you start putting these things in these little buckets and go, well, where am I? Maybe I'm a sit on my hands and wait kind of guy. That is where we're at here with our funds at Jazz Wealth. We have some cash in our portfolios, and we would like to use it on a pullback. We are not currently deciding that there's anything of significance to do where we would go in a big way there. So still learning the rules, what I can and can't say there. I see the people on TV go, we're adding to this position and adding to that one. I'd love to be able to do that, but they tell me you're not allowed to do that. But then why can the guys on TV who have the same license that I do say it, but I can't say it? So we're working with compliance on that, because I'd love to be able to say, like, this pullback in the market makes us want to be interested more in, tech or whatever it is, and actually follow along with that. Because we manage our own portfolios here at Jazz. We do not go out and buy mutual funds and do the lazy thing there. But anyways, that's the update for the closing beat here today. little bit raw. I know it's a little different. I tried to put this thing. See, it looks somewhat fine right now. Anyways, hopefully we'll be back officially on Thursday, possibly tomorrow, also maybe in a little raw way there, but I will definitely be doing the show one way or another. You guys enjoy the rest of your day or evening, and if you would, hit the subscribe button if you haven't already. It makes us look bigger, you know? It's helpful. Thank you.